So this is going to be a little bit more of an advanced type pace, and we're going to talk about a number of things. I mean, we'll talk about support and resistance and the decision levels and so forth that we've talked about before. I'll get into the chart patterns and PowerStats. We'll talk a little bit about Fibonacci and pivots, because really what they all serve is kind of the larger topic here, and that is, how do they factor into the entry strategies. I'll talk about some recent trades, but whenever we're talking about different ways to find support and resistance, we have to bring in the topic of, to me, one of the things that I probably am guilty of this. I don't talk about it enough, which is this idea of, can you afford the trade? Okay, so once you've drawn all these lines and levels and used some of the automated tools and so forth and set up the entry, at some point there's got to be a step back. Okay, even though the topic of support and resistance is one that's talked about a lot, and all the myriad of ways you can discover these levels, these decision levels as I call them, the bottom line is, they're facilitating the ultimate question, which is, am I going to get into this market? And part of that is, can I afford to even get into the market? So that's going to be the way we intertwine the discussion here. So again, a little bit more advanced. It's the part 2, but I think even for those of you that might not get it on the first go round, hopefully we're going to elevate the discussion to where when we meet again, we can take this more advanced discussion, take this idea of pivots and Fibonacci and chart patterns and PowerStats and incorporate them all into the setup, the stop loss, and the decision about, can I afford it? All right, so with all that being said, let's go ahead and head on over to the chart, and let's go ahead and start to discuss the setups. Now, part of this obviously is that triage process, starting with the daily and understanding the directional bias, and then understanding the clarity of the 34 EMA wave, identifying the market trend. So where we're picking up now is, once we've done all that, under what context are we trying to determine the usefulness and the applicability of the support and resistance levels? So all that means is, we'll talk about some of the different tools that we can use. I'm going to introduce PowerStats as a way to factor in how likely it is we're going to see some of the levels that we've drawn in our charts. And then we'll talk about, can I afford this trade, not only using PowerStats, but also using the lines and levels of the setup itself. So it's a big topic, but I think it can be broken down into a fairly straightforward, simple piece-by-piece instruction. With all that said, let's talk about, and I'm scanning right now just some of the charts on my screen, and the euro and the euro US dollar and the cable are popping up as potential discussions. So we'll get to those two. So let's start with the cable, and let's go with directional bias. And again, daily chart, most psychologically significant way of looking at that overall dominant trend. And therefore, it's going to help me determine which time frames to focus on. I'm not as interested in the support and resistance as a part of the directional bias conversation, although I would be remiss if I didn't look at couple prior lows, or even the way the 200 period simple is acting as resistance right now. But really the focus on the directional bias front is just the wave and the grab candles. Then I can start going to the time frames that I think are most applicable. What's interesting about this cable right now, and let's talk about the two setups that are happening and go into detail about them. So first of all, what are the support and resistance levels that I can apply to this chart? This is a 15-minute chart. I can look at the 15 or I can look at the 30-minute time frame. Those are the two short-term time frames that I feel would be best to focus on because of the lack of directional bias on the daily. Again, short-term would be, I think, most appropriate. And I can look at the past resistance levels as we climb higher. And because we don't have quite yet, although it's trying to get there, okay, this 30-minute time frame is definitely trying to get to a 12 to 2 o'clock. In fact, we might be looking at the very beginning stages of what could be a transition from that more volatile sideways 2 to 4 to a 12 to 2 o'clock angle. So that's something we need to recognize as part of this triage discussion, part of understanding the role of support and resistance under the context of this transition. If this is a market that could be heading up higher, 12 to 2 o'clock angle, my more appropriate setup, based upon the support of the wave, would be to buy into the pullbacks along the area between the 20 period simple and the 34 EMA high. That would be a swing buy opportunity. Because it's transitional, and in terms of the clarity readings, I haven't quite gotten the established quality out of this wave reading yet. The reason that as I compare, and by the way, that's where triage came from. Triage is just something I call it because if you look at the word triage, I liked what it implied. Because if you think of it on the medical, in the medical world, it's not just sorting, but it's prioritizing. Prioritizing where your attention is going to go. And I liked that dual meaning of just not just sorting, but prioritizing and sorting. That's why I like the word triage for what I do. Okay, that's why I call it that. And so as I look at this 30-minute chart, I have to acknowledge that we could be under within that process of the transition into that 12 to 2 o'clock, which would make being long the better position to be in. But since we are transitional, we haven't established that uptrend yet, these resistance levels are hurdles to the upside that we're going to have to contend with. And therefore, if this were a clear 12 to 2, it wouldn't be as big an issue about being long. Those hurdles upside would just be profit targets. But because we're in transition, those hurdles to the upside could still be resistance. That's the challenge here. So, with all that said, could one of the better approaches simply be to not do anything? Absolutely, because if you have doubts, you're probably better off, even regardless of even with all the support and resistance we could see here, you're probably better off not getting too aggro. Now, I could step back and let PowerStats help me out a little bit by looking at the projected support and resistance levels over the next 15 minutes to 4 hours. And it looks like over the course of the next 30 minutes to 240 minutes, it looks like, based upon the PowerStats of this area that I'm drawing trend lines on right now, is going to be a significant layer of resistance. And that lines up with pretty well some of the past resistance levels going back into the 15th even. So going back to Tuesday and Wednesday's price action, now Thursday's price action, it does overlap with levels that I'd be watching for exhaustion. So therefore, could it be best to possibly fade this area? Well, here's one thing you can do, and there are two simultaneous setups. Let's talk about each one of them and the risk and reward associated with them. If this is an uptrend, I could buy into the pullback that we're seeing right now between the 20 period simple. Actually, is the 20 even a factor here? No, not quite, is it? That 20 period's not even in there right now, is it? Let's zoom in a little bit more and look. No, it's not quite. So it'd be the 34 EMA low, a high, 34 EMA high. So your buy would be right here. And I'm going to go ahead and paint the buy blue. So if you bought at this area here and rode it up to this first layer of resistance, so from this blue level to this red level, that'd be a pretty good potential upside, right? But only if you compare it to what the downside is. What's the downside? What's my risk associated with a swing buy? My point of validity is the support of the wave, and that extends all the way down to the 34 EMA low. I'll paint this green. So my risk would be from the blue, which is my entry, to the green, which is just below the 34 period EMA low. My reward would be from the blue, which is my entry, to the first layer of resistance. So, we could count pips and all that kind of stuff, but I'll tell you, realistically, risk-reward ratios based upon support and resistance will offer you typically a 1-to-1 or maybe a 1.5-to-1 risk-reward. That is not uncommon, and that's, again, not based upon my tolerance of risking 20 pips to make 50 or something haphazard like that. It's based upon the support and resistance of my entry and the support and resistance of, I'm using PowerStats here, I'm using a combination of moving averages and past highs. Again, chart-based. I am risking slightly less than my upside target may be. In fact, I should probably move this target down to that prior high, which would put us at about 5,800. Not only is it a major psychological level, but it was where we topped out before. And an interest in stepping out in front of size, it'd probably be even better to put this level just in front of the 5,800 level at 57.95. Now, let's re-examine that risk-reward. It's closer to 1-to-1 now, isn't it? In fact, it looks slightly like more risk, slightly more risk than reward to step out in front of that 5,800 level. Can you afford this trade comes from, number one, I don't want to risk more than I could potentially make. Another thing I could do, just as I respected the support of, this high here was 5,800. Going to move this down to 57.95. Just as I respected the prior high, I could respect the previous low within this range right now, near-term low. That's 57.50, another major psychological level. I love that. And by the way, it's also overlapping with the 240-minute low. Now, by the way, you'll notice there's 30 and 60-minute levels, 240-minute levels on both sides because it's identifying a range for the next 4 hours. It's identifying a range for the next 30 minutes, 50 minutes, etc. So the low, possible low, over the course of the next 4 hours actually overlaps with the major cycle level and the previous low we've already hit. Could I then consider that near-term low to be an optional cheated in stop loss? Now, I'm not breaking the rules of recognizing support and resistance as important within my trading plan. I'm certainly not ignoring past price action. I'm simply no longer using the point of validity, which is the wave's low, as a stop. So it is cheated in. I call this cheating in because I'm moving away from the point of validity and to just an alternate level of, this case, support. Does this make the trade a little bit more affordable? This is what we do when we start to look at the risk and reward of a trade. Again, it's all chart based. Everything that I put on here in terms of support and resistance is based upon the previous price action and my belief as a chartist that previous price action will give me insight into where decision levels could create an acceleration or a stall or a reversal in price action. And we haven't even introduced ideas of say, for example, putting in trend lines for patterns. We've got kind of a, not quite symmetrical, but closer to being a symmetrical triangle here, depending upon which touch points I want to use, developing in this market. And this triangle is not necessarily an invalid pattern because we haven't established a trend yet. So if we still are moving in a sideways range, as this time frame is undergoing transition, this triangle is necessarily not invalid. We're just not sure if this market is going to continue into a trend, in which case the triangle really just becomes, to me, a resistance level, a downtrend line resistance level to watch. Don't forget the pieces of the whole. The triangle is simply trend lines. So a lot of decisions here, but I wanted to kind of choose a complex example because, again, this is a little bit more advanced, and this is realistic. This is what's happening right now, gang. I don't know what's going to happen, but this is the process that I'm using to help understand and put some parameters on what I may do and how I may do it based on what I'm seeing right now. Again, I have the bearish sentiment and momentum on the daily, but I don't have the downtrend. Now, the other interesting thing about the cable is that the 240 has what really is starting to shape up as a nice 4 to 6 o'clock wave. So on the 240-minute time frame, we're seeing, I think, what is a downtrend that looks like it wants to continue, especially if it can exhaust at the resistance of the 200 period simple, which you can see it in play here. In fact, let's clean this chart up a little bit. So if prices can continue to correct higher, we have the resistance of the PowerStats in play here, the 240-minute resistance level, again, the high of what could be the range over the next 4 hours. The 200 period simple and the 34 EMA wave, all happening in one area. This area that I would deem to be a swing short. Now, the only headache with the 240 is the daily chart does not have a trend, and without a trend, I'm not really a big fan of getting into a time frame that's going to require longer term organization of sentiment and momentum. That's my problem with this time frame. So when I look at this 240, one thing I can remember is that the exhaustion that we thought we might see on the cable, on that intraday time frame, is occurring in a very similar area. So the fade that we could have set up on the 15 or 30 does lend itself to cooperating with the resistance that the 240 is projecting. So whether it be a distribution fade intraday or whether it be a swing short based upon the 240, that seems to be the direction in which I would want to engage the cable, if at all. Again, if at all, because let's not forget the kind of volatility we're seeing. And without that clarity on the daily time frame, it's much more difficult to look at the broader market, the herd, if you will, and say, okay, are they willing to position themselves at support, or are they willing to position themselves at resistance? And within the context of a trend, it's oftentimes a whole lot easier to understand where the pain is going to be too great for the herd. And what I mean by that is, I'm talking about that level. We're all familiar with it, but it's a level that is a very strategic level for a lot of us. If we can understand it in the context of the market's threshold, is what I call the stop loss of shame. The stop loss of shame is that uncle point for a losing trade that's way beyond where the stop should have been, way beyond the point of validity. It's that ultimate pain level for most traders in the market. Well, I think it's easier to understand that context when the market's trending. It's much more difficult to understand where the majority of traders are positioned at and expecting support to be waiting or resistance to be waiting when there is no direction, when there is no dominant trend. Much more difficult to determine a lot of things in a non-trending market, because why? There's no dominant psychology that I can rely upon. So while I can draw all the Fibonacci's and look at the PowerStats and do all that, the bottom line is, there's a Fibonacci level overlaid here. The bottom line is, it's harder to determine what these levels mean because they're not occurring within the context of a trend. So you can't take the trend out of, or the directional bias and the market trend, market phase, out of the conversation. What is the stop loss and so forth for this trade? Well, let's talk about the entry. The entry window is between the 20 period simple. Again, I'll paint the entry blue. And I literally do this. I'm not just doing this for the webinar, gang. I do this literally on my charts. That way I can visually look at what my risk is. So there's my window, or I should say my zone. Okay, so this is the swing zone where I would want to short. The validity of this trade would carry me to just above the 34 period EMA high. Now, right away, I can see what could be a potentially interesting cheated in stop area. And that would be at this level right here, because it overlaps with another PowerStats level as well as two previous lows. See that right here? Boom and boom. So two previous lows are in play there. What was once support becomes resistance, right? At one point these were support levels. Okay? And now, on the way up, they could become resistance levels. So that could be an interesting cheated in stop. So I'll keep both those levels there. And if you want to differentiate between the two, maybe you make the second horizontal line thinner. That's fine. Whatever you need to know, whatever you need to do to differentiate the lines. Point of validity versus, say, cheated in. Let's go to the downside. Once we exhaust and start heading down lower, if that's the case, I can recognize the PowerStats as a level at which prices could exhaust and find support. I could also look at the previous, and by the way, that does line up with the previous, so I could look at the previous low down here. In fact, I kind of like the body of these two candles right there. I would actually look at this as not just the choice between two profit targets. I would actually look at this as profit target 1 and profit target 2. So, look at the entry area to one of these two stop losses. Look at the entry area to the first and second profit target. Is it a 1-to-1? I think it's awful close. I think the cheated in stop here has a lot of validity, if I do want to use that. Let's talk about the entry. Okay, let's talk about the entries now. This is a stop. This is a swing short. You have all the support and resistance levels here. I have my PowerStats support and resistance level here. I could drop a Fibo on top of this if I wanted to. See if there's any overlap, any interesting overlap here. Okay. But what I want to do now is actually talk about the way we enter. Now, the way we enter is I'll put a limit order at definitely the more conservative level, which would be the higher of the two blue lines. I could put a limit order at the more aggressive, but that's going to be aggro, so I want to make sure I recognize that as being aggro. So those would be limit orders. The stop loss is up at either the cheated in level. We have to recognize the cheated in level as being cheated in. Okay, you have to recognize that as being a cheated in level. So I could label that cheated in, and then I want to recognize the level that represents the validity of the trade, and the point of validity, and that's up here. I've got my first profit target. Again, not just based upon, notice I haven't even talked about pips or dollars yet. These are just lines and levels that I'm seeing on the charts, and I'm recognizing them as such. That's my profit target number 1. And then we can have profit target number 2. And that is the setup for all the lines and levels on this chart. The next thing that I want to do, and let's kind of move forward in time. One is, and this is a good question, do I scale in and out? Scaling in, I guess, technically, if I've got two entry levels, I guess you could say, technically, yes. In this case, because of the swing buy zone having two distinct levels, I do scale in this case. The aggro would be about 1/3 to 1/4 to 1/3 of my overall position size, while the limit would be the limit order, the conservative order. Higher up would be the remainder of the position. So in a typical 4-lot entry, 1 lot would be entered at the aggro, 3 lots at the limit. Let's say you get in with 6 lots. You could put 2 at the aggro, 4 at the limit. So just aggro is not where you pile in. It's where you get some skin in the game. That's it. Limit represents the remainder. So let's say we get our fill. Now, one scenario is we hit our stop loss, whether we use the cheated in or the point of validity, and the trade is done. Those two red levels represent a risk-based stop loss. In other words, they represent a loss of our capital. Not a profit, a list of our capital, our principal. If we go down to the blue lines, those entry lines to the first or second profit target, obviously that would represent success, right? The trade going in our direction. And here is how we begin the trade management process. Because this is the process we all hope to get to. This is the process that every trade we hope begins, but we know not all we'll get to. But let's take the other side. And that is, if we get in and prices start to move down lower, at the first of the green lines, boom, right there, we want to have an order waiting. That's our profit target. We want to have an order waiting so we can realize a profit. Now prices might kind of bounce from there because after all it is a support level, right? We should expect a little bit more of a bounce, okay? And prices then may go down to the second profit target. The way the trade management works is when we get to the first profit target, and this is a very important discussion because all of you have heard the saying, I'm sure, don't let a winner turn into a loser. How do you define a winner? That's such a huge question right there. How do you define a winner? A winner, in my opinion, again, these are all, the only thing that a trader can share with anybody is their opinion and their experiences. So obviously, gang, these are my opinions, my experiences, no one else, okay? I'm just sharing with you what I've observed over the years. So no one ever teaches us how do you define a winner? We just hear, don't let a winner turn into a loser, which in and of itself is just fortune cookie wisdom. How do you do it? Well, I define a winner by the first profit target. So the placement of that first profit target just took on monstrously important proportions, right? Because if that's where I define a winner, by my first profit target, and if at that point I'm going to begin all the trade management ratcheting, so to speak, I don't want to get piggy about my first profit target, but it still has to be within the balance of these support and resistance levels that we've just drawn. It still has to be within the balance of, can I afford the trade? Well, we talked about the blue area being the entry. We talked about the red areas being the options for stop losses. The green areas are the two profit targets. We don't want an imbalanced trade. I will accept no less than a 1-to-1 risk-reward ratio. Anything less is really a waste of time. At least a 1-to-1. If it's more than that, great. But notice that I have not talked about pips, percentages, or dollar amounts. This is all chart-based. And I think when you use the charts, more often than not, you're going to see the way support and resistance pans out, it's going to give you a 1-to-1. Sometimes it gives you worse. Those are the trades that you can't afford. The risk-reward isn't there. It's not logical. So, with all that said, I want to focus in on two things. One, I have to choose which one of my stops, okay, I want to use, whether it be the point of validity or the cheated in. It's really up to the individual. There's no right stop loss. There's no magic level. I'm just trying to use past support and resistance to try to identify where that decision level may be. And when I keep referring to this idea of a decision level, what I want you to understand is that a decision level is simply this. I'm trying to identify a level on the chart where prices could accelerate, they could stall, and or reverse. That's what a decision level is. That's what support and resistance is all about, trying to find a decision level. Because if we found a level at which there is a reaction, that's what it's all about, the reaction, prices will either accelerate, they'll stall, or they'll reverse. That's all they can do. But we want to see the reaction, because if we see the reaction, that means we've identified a strong and relevant support or resistance level. So support and resistance levels are decision levels. We could draw support and resistance levels all over a chart. That doesn't mean that they're all going to be decision levels. So decision levels will be support and resistance, But not all support and resistance are ultimately going to become decision levels. Again, because we know that sometimes prices don't react to a level that we've drawn via pivots or Fibonacci or whatever. So we seek to find those decision levels, and we know that at some point it's going to be some sort of support or resistance, whether it's a psychological number or whatever, but we're looking for that reaction. Very important point here when it comes to understanding support and resistance. So in this conversation of how do you define a winner, a winner is defined by finding yourself at that wonderful point in time where you can reach a profit target. A lot of traders get all happy and just crazy when their trade just goes in the black. That's not a winner. That's just a trade that's covered the cost of entry, right? Anywhere between this entry level or either one of these entry levels and the first profit target is no man's land. No man's land is an irritating place to be, but it's better when it's on the side of, obviously, the profitable side. It's a whole lot easier to sit through no man's land when the trade's in the black. And by the way, you have no man's land on the negative side too. That area between the entry and the stop, that's no man's land too. That's much more irritating because obviously that no man's land, you're sitting around watching the trade in the red. That's not fun, but it's still no man's land all the same. In other words, there's nothing to do. There's nothing to be done. You're sitting and waiting for your trading plan to follow through, and you got to give the market the wiggle that it needs, the room to move. And yes, you'll be taking heat up here, but it's not a loss. Heat is no fun, but it's an unrealized loss. So again, very important that you define a profit target that is in balance with at least a 1-to-1 risk-reward ratio, and you deem as an affordable trade. Now, what's affordable? I have no idea what it is for anybody in particular. You have to look at your account size. You have to look at your account balance. You have to look at what you're comfortable losing and ask yourself what's affordable. Because you might look at this trade and say, I can't afford this, or you might look at this trade and say it's cheap. I don't know. That's something you personally have to decide for yourself. If you took the loss in this account, would it put you out of business? Psychologically or literally in terms of dollars and cents. That's the question I don't think you can plug into a formula or a calculator. Such the psychological aspect of it. Okay? Now notice we're actually reaching our entry level not only on the fade, which we looked at earlier, but also on the swing. So by the way, the fade is also potentially triggering, and if your stochastic right now is going overbought, which I can tell you because I've got these charts on another screen here, if they're overbought, this is actually a fade as well. So remember, the fade is triggering off at the same time that the swing on the 240 is triggering off. So two different approaches, but the same thinking. I will mention the 240 has a whole lot more risk. One, because it's a longer term time frame, and two, because the point of validity is way up here above the 34 EMA high. On the 30-minute chart, or the 15, I think the 30 is what we talked about, in terms of the trade being triggered right now with the overbought stochastic, that stop loss is much tighter. Remember, it's 10 pips above the highest high of the range. So you're looking at less risk in terms of the entry. much more affordable for a lot of traders. And again, this goes back to, can I afford it? If you want to get short this market on this rally higher, I shouldn't say rally, on this movement higher, and you want less risk, your setup with less risk would be the distribution fade on this shorter term intraday time frame on the 30 versus the 240. Now, if you're willing to take a longer term trade and you're willing to take a little bit more heat, the 4-hour might be your better setup. Now let's talk about the management. It's going in your favor. We hit the first profit target. Once you've hit that first profit target, you no longer want your stop loss way up here at the point of validity or at the cheated in. You want to take it to a break even. Now you can use the conservative level. That's fine. I would recommend using the conservative level, not the aggro or aggressive level. So you take that stop loss, and now you move it to a break even at the limit here. So your break even now represents either no loss really, or a very muted loss. And for me, the break even is going to be 3 to 5 pips above this limit order. Whatever this was, you want it just above that level. That's your break even. It's basically your entry based upon the charts plus about 3 to 5 pips. If prices continue to go in your favor, we'll go to this, and it goes to the second profit target that we've defined here. And all these lines and levels, minus the labels, should be on your charts, preferably with a price level written down somewhere or already inputted on your platform. Your second profit target would then begin the ratcheting. I call it a ratchet because we tightened it from point of validity or cheated in to break even. And then once we get to the second profit target, you know, some of you that are willing to let the market wiggle some more, and here's where I don't want to keep it really subjective. We'll head on over to PowerStats here in a minute. Rather than the subjective thing of saying maybe you can, maybe you can't, I would tell you to go to PowerStats, look at the time of day, and ask yourself, am I dealing with a higher volatility time of day, a higher volatility pair, a higher volatility economic calendar, or a lower volatility scenario? Because that's going to dictate whether or not you should likely cheat in the break even to the trailing stop. So if you're in a lower volatility environment, go ahead and trail it down to the first profit target. In this case, plus 3 to 5 pips. So just above. If you're in a higher volatility environment, maybe you're just going to go ahead and trail it to the aggro. So here's where an understanding of time, of an economic calendar, and of the volatility of the market is going to help you determine how aggressively you should ratchet. You're going to ratchet. You should ratchet. Okay, again, we've defined what a winner is. We don't want to let it turn into a loser. Once I've hit that first profit target, there's no way I should keep my stop loss way up at the point of validity. That would be silly. I want to give up all that profit. Number one, I want to realize some profit. So I want to take some of my position off the table here. That's number one. So if I have those 4 lots, I'll at least take 1 lot off the table, if not 2. And then I can keep the remainder possibly gunning for the number 2 profit target. But in the process, I don't want to be at a full-blown loss the remainder of my position. So I must trail in because, again, I've defined what a winner is, and I will not let it turn into a loser. And again, notice I'm using these support and resistance levels to make all these decisions. Now, I mentioned the PowerStats. So as I'm logging into the PowerStats, again, the whole idea behind the PowerStats is understanding time and volatility as a function of where prices could travel to the, we have a whole bunch of support and resistance levels on here, right? We have a ton of them. So what is the likelihood of prices traveling to one of those many levels that we have labeled on our chart. So here comes the PowerStats. So looking at the auto chartist here, I want to get over to what's going on in particular for this pair. So let's zoom in a little bit here. And that means understanding the volatility at this moment for the cable. So if you click on the cable, and I keep individual searches for the pairs that I trade most often. So if I click on the view analysis, the same PowerStats ranges for the next 15, 30, 60 minutes, 240 minutes, and daily are on this as a graph. Those are plotted as support and resistance on my chart. That's what we've been looking at. But there's also the movement per hour. And this is what I'm talking about in regards to how aggressively or conservatively you're going to ratchet in terms of your trade management. Heck, even in terms of whether or not you should cheat in your stop or not, whether it's a proper environment for that. You have to look at your price movement ranges and look at what kind of price movement you've allowed on your trade, and make sure that it's in line with the personality of the pair. And the personality of the pair here, I think, is charted out, graphed out very nicely in terms of average price movement, which is the band across the green bars, and the upper and lower range. Now, how do you know if you're going to be in the upper or lower range? Look at the economic calendar. Look at the current trading environment. Look at the headlines. You know, this is where understanding some of the headlines in terms of your market is very important, because the headlines will also dictate how much attention is on the pair, and also, therefore, what kind of volatility you could see in the pair. And the pound's been in the headlines the last couple of days, especially after yesterday's really dramatic sell-off. We've recovered pretty sharply, you know, from that, by over 100 pips at this point. But you got to look at what the headlines are and what the price movement has been, and make sure that you are recognizing the type of volatility you're seeing and making sure your support and resistance levels are in line with those expectations. In other words, if you have a bunch of very tight support and resistance levels to current price versus those that are further out, you can get a better idea of which will actually be in play and which won't. The times on this graph are in New York time, Eastern Standard Time. So this would be midnight, 0 would be midnight, and 2300 would be 11 p.m. Again, Eastern Standard Time. All right, let me turn that sound off here. There we go. That is irritating. All right, there we go. So, oh, by the way, for those of you that have this running in the background, as I do, I should mention you could just turn the sound off using that little speaker icon right there. Okay. That is a breakdown of the cable, and we're just kind of seeing it happen right in front of our eyes right now, which is great. That's another reason I love doing these things in the live market. There was mention that there is a trend on the cable. I'm sorry, on the pound yen. Okay, we can take a look. Not a pair that I trade a lot of, but we can take a look at the pound yen. And by the way, for those of you that are scanning the markets as we're looking at these charts, if there is a trend on any of the 5-minute time frames, for those of you that were asking me about the 5-minute between the greens, if there is a trend, there needs to be a 12 to 2 or 4 to 6 o'clock trend. If there is a trend on one of the time frames, let me know and I'll pull that up, because I need a trend on that 5 minute to show you the setup. All right, so let's head on over to the pound yen. Start with the daily. Again, not a pair that I trade a lot of. I know a lot of people do fancy this pair because of the volatility, but usually when I trade this pair, it is actually using the between the greens. That's one of my preferred ways of trading it. So starting off with the daily chart's directional bias, do I have a bullish or bearish bias? No, I have bearish momentum now after what was a kind of bullish period. Very bearish before, though. So lack of directional bias means what? I'll focus on the 5, I'll focus on the 15, I'll focus on the 30. The 5 has a pretty decent 12 to 2 o'clock uptrend. So actually, let's just go ahead and set up a between the greens here real quick. So in order to set up between the greens, you actually need to have a separate chart. So I'm going to go ahead and pull up a new chart. And on this new chart that I've just pulled up, I don't know if I have a template for this already set up on this. I may not. I don't believe that I do, but we'll do it together here anyway so everybody can see what I do. All right, so you can keep the grab on there if you want. It's not necessary, but you can. Since it's a 5-minute chart, you can't use the PowerStats. So what I would tell you to do when it comes to grab, one thing you could do is actually, and I do this on my 5-minute charts, is go through each one of the GRAB, go to the number 4 indicator and turn them all white. Or basically what you're doing is you're matching the color of your background. So I'm going to show you what happens here. Basically what I'm doing is I'm making the wave go away, because I already have the wave on another 5-minute chart. I'd like to keep the grab, the color-coded candles, but I don't need the wave because I'm going to have a whole other series of moving averages on this chart, starting with the 13 period exponential moving average on the close, which I'll shade in a light green. Usually I'd go ahead and choose the lime green. The second moving average I'm going to add is the 21 period, also exponential, on the close, and I'll choose the darker green. Those are the between the greens. That's the beginning of it. That's the between the greens there, because the two moving averages comprise the area in which I will look for buying opportunities. And again, this setup is only valid when the 5-minute is trending. It's only valid when the 5-minute is trending. So the area between the two, and I just lost, okay. That's one of the headaches. Let me just mention real quick, I forgot to say that. When you do white out the lines of the wave off your grab, you have to save it as a chart. You have to save it as a chart, okay? And open up that chart when you want to do it again. Kind of a pain. I'm actually in the process of requesting that Interbank create a 5-minute specific between the greens entry where you can keep the grab candles, but you don't necessarily have the wave on there, because it just confuses the whole issue with the entry. In fact, what I even like to do on the entry candles is make the between the greens lines a little bit thicker, because that really is my focus for the entry. That's easier to see. So we actually have a between the greens entry right now as it applies to the pound yen. And again, the whole trade is valid only because the 5-minute on the wave is in a 12 to 2 o'clock uptrend. So the entry is between the 13 and 21 period. You can put a limit order there. It's very similar to entering a swing trade. In fact, it is simply an intraday swing trade based upon a shallower correction to a faster, shorter moving average. All right, let's introduce the remainder of the moving averages. We have a 34 period, which is, of course, the middle line of the wave, and that is in red. And the last moving average we need for this setup is the 55. Now, notice these are all Fibonacci-based moving averages. For those of you that are familiar with my Lazy Days lines, very similar in terms of my love of those. So this 55 is usually a maroon. So I did lime green, green, red, and maroon. And that is your between the greens setup. On a short-term time frame, like a 5, you just simply don't have the luxury of time, and therefore, excuse me, you don't have the luxury of time-consuming analysis. So the most powerful thing you can do for yourself in a short-term time frame is make the entry as visual and not calculated, in terms of having to calculate different lines, levels, and time-consuming type analysis. You want it as visually available to you as quickly as possible. You just don't have the luxury of time. The 34's job is either to act as a cheated in stop, which I do not do very often, if at all. It really is a warning track. Its function really is to serve as a heads up that you're taking heat on the trade. And if you haven't put your stop loss in, do it. The 55 period exponential is your stop loss. That's where you want to put your stop minus 3 to 5 pips in this situation to protect yourself. That is the validity of the trade. Now, if you have a psychological level nearby, if you have some sort of secondary level that you can rely on in terms of importance, past support or resistance, or again, psychological level, or something that you realize could be a decision level, go ahead and use that. Some traders might say, oh, that 50 pip level could be very important. And I agree, it could be. In fact, I think right now we're basically battling at that 50 pip right now. And arguably, for now, while it might be the battleground, I'll go ahead and just kind of put an aqua in here, thicken it up. It's a battleground for now, and there's a pretty good argument for a little bit of downward acceleration if the bears overpower the bulls at the 50 pip major psych level. There's a pretty good argument. You can see the battle's still going on right now. But again, if we break that 50 and acceleration begins, we could see the 34, the 55 very quickly. So we're seeing a major psych level. And while this would have been great in terms of support, and I think it still could be, as we can see here, you can just see this candle going crazy right now because we are at that major psych level, that whole round decade level where a lot of orders are typically sitting. But that is the setup. Your entry was triggered, here's your warning track, and then your stop loss is just below the 55 period EMA close. And that's how we set it up. Now, what about risk to reward? We can't take that out of the equation as far as whether or not you should take the trade in the first place. There are two levels at which prices have peaked recently. These are both resistance levels. Now here's where the trade really is either decided to be taken or not. Can you afford the trade? Is it a decent risk reward? Again, notice I'm using really obvious levels. I'm using levels at which we've topped out before. It just takes me a few moments to draw those lines in. My risk to reward actually looks pretty good. This blue area basically is the conservative level of the trade. It's a zone, if you will. It's between the 13 and the 21. So this blue area represents not just the 50 pip, but also, give or take a few pips, your entry. So your entry to your first profit target, your entry to your second profit target, your entry to your point of validity. It's easily a 1-to-1, if not a little bit better. So is it an affordable trade? Yes. The other aspect of this is time. We have to be realistic about the time. Look at the time, look at the volatility. I don't like taking between the green setups when there's economic reports pending that could affect the pair. Too much volatility for too short a time frame in terms of the validity of the trade. Okay? So for now, this 34-period EMA is acting as a little bit of support, as we're probably still battling it out around that 50. And by the way, where does the battle occur around major psych levels? About 3 to 5 pips at the top, 3 to 5 pips at the bottom. So it's an area that's going to occur between 121.55 and 121.45. That's where the battle is going to occur because of the spread. And that is the setup. That's your between the greens from beginning to end on an example that we're watching happening right now. And again, support and resistance all the way. Nothing but. Could I pull a Fibo here? You know, on a short-term time frame, I'll tell you probably refrain from doing so. Again, you don't have necessarily the time to do it. But on longer-term time frames, go for it. Chart patterns, if you want to use the automation of AutoChartist, you can do so, but not on such a short-term time frame. It'll have to be the 15, 30, 60, 240 or daily. So we'll just watch this thing kind of bounce back and forth. And this is a low volatility time. You know, look at the clock, consider what the rhythm of the market is. In fact, let's go ahead and let's take a look at the PowerStats for this pair while we're at it. So pound yen, what's the rhythm? What's the price range forecast? Okay, what's the movement per hour? Obviously, we're in the doldrums of the day. We're entering we're in the doldrums of the day, lower volatility, as opposed to earlier in the day with Europe, UK, US, and the remainder of the day. So you have to take that into account when you're looking at your follow through and the velocity. Don't forget that aspect of it as well. Okay, well, I hope that you've had a good, thorough look at the way I use support and resistance within the context of my trading. I hope you've seen some of the, I mean, we had some great live trade setups right now. You can watch them through the day and see how they do. But what I'm hoping you took away from this was how support and resistance factored into affording the trade and the trade management. That's really what I wanted you all to see. And I don't have a lot of video on that, so I'm really happy that we got this down here today, because this is something that I don't actually talk about a lot because it is so time consuming and detailed and sometimes a little dry, but it's really, really, I don't think you can separate that from the discussion of support and resistance. I don't think it's something that should be separated, because that's the whole reason we look for support and resistance, right? To identify those decision levels. So thank you very much for your time. I know this was kind of a intense, in-depth session, a lot of detail, a lot of breaking down, a little bit of repetition, but I hope that it was helpful, and I appreciate y'all letting me put this presentation on. It's probably not a typical presentation when it comes to support and resistance, but it is an advanced look at putting these levels to work. So I hope everyone has the remainder of your day, evening, morning, whatever it is. I hope you have a wonderful day, and I'll see you in our next session.